settling in quiet right now. Let's take the conversation forward. We've got Gautam Duggar as well joining in on the show right now. Gautam, hi, morning. Great to have you on ET Now. Gautam, so much has happened, right, with regards to what the government has done in terms of pushing demand and growth higher. I mean, be it the rate cuts from the RBI, be it all the taxation cuts which are still trickling into the economy. And then, of course, this big GST bazooka. But Gautam, that's not really reflecting on the markets. Why is that?
Hi, Aisha. Good morning. Thanks for having me. Yes, I mean, this is something which has perplexed everyone over the last 24 hours. But look, Aisha, there are 2-3 things at play here. First and foremost, this relentless selling from foreign institutional investors. I mean, just to put numbers in perspective, in the last 20 months, and calendar year 24 plus first 8 months of calendar 25, foreigners have sold $15 billion. Against that, domestics have bought $123 billion, $63 billion last year, and $60 billion roughly in the first 8 months, right? So if you focus on just calendar 25, again $60 billion, we have seen $15 billion of selling from foreigners, and roughly then you have seen a lot of activity on the primary market, corporate blocks, promoter blocks, PE blocks. So that is a pressure of supply which has kept the market a bit suppressed. Second, the valuations of Nifty at about 21, 22 times, while not exorbitantly expensive, and even for that matter, mid-cap, small-cap indices at 25 and 27 times, they are giving some bit of discomfort. Typically when your earnings grow at 15 to 20%, 22, 25 P do not look expensive. But when earnings grow at 5 to 8%, the same 2022 P look slightly expensive. Right. So last entire year FY25, our corporate earnings growth was literally zero. You've seen 1% Nifty EPS growth and 4% absolute profit growth in the broader markets of roughly 325 coverage universe companies that we have. Now, this year we have an expectation of about 8 to 10% earnings growth. First quarter was pretty good. We've seen earnings upgrade in mid caps while marginal downgrades in large cap and small caps. This is giving us a hope that we will end the year at about 10 to 12% earnings growth. And as the cumulative effect of all the actions that you just enumerated, they take hold, the rate cuts, income tax cuts, the GST cuts, infusion of liquidity, you have a good festive season around the corner. We hope that sentiments will lift in the second half of the fiscal year, that is starting 1st of October. And then market may at least trail the earnings growth that we're expecting this year. Till then, it's going to be a very bottoms up, stock by stock, sector by sector market. So you saw very good rally in auto index in the last 15 days. In fact, so much so that auto is now the best performing index of the year. It was banking till August. Now it is auto after the 6-7% index rally. And typically what happens when such a big news is anticipated, usually we have seen that market take some profit off, buy on rumor, sell on news. That sort of equation played out yesterday. But keeping the day-to-day or week-to-week market fluctuations aside, this is a very big step that the government has taken, probably the best and the biggest reform that the government would hope to undertake in its third term. Let's see, they have a lot more on the anvil. Mr. Piyush Goyal at our conference this week, at our 21st annual conference, he spoke and he mentioned about a series of initiatives that the government has planned. Prime Minister himself has hinted about arsenal of reforms that they're going to unleash. So we'll keep our hopes intact.
Gautam, next time you must invite us also to your conference.
More than welcome.
No, but just coming back to the earnings point that you were making, that where do you think earnings revival, or rather what is going to lead the earnings revival? Would it largely be consumption driven? And will it not be the same as was the previous time wherein you had CapEx as a theme which took the lead?
So Aisha, CapEx has played its part in the last 4-5 years, both on the public sector part, which is the government which has led it. We had a total CapEx budget of 1.9 trillion rupees back in 2019. We've almost reached somewhere close to 11 lakh crores. So this is a 5.5 times growth in the last 5-6 years. And I think government has rightly shifted focus from this year's budget from CapEx towards consumption. It was long overdue because consumption has been literally, for want of a better word, dead for last 2-3 years, especially the low ticket items. Now, what we are going to answer your specific question on what is going to drive this 8-10% earnings growth, big sectors are not participating. Sector by sector, if you see banks, after a stupendous earnings expansion from 2018 to 2025, where our coverage universe on financials, and that's very large coverage universe, 65 companies, they've seen their earnings expand from 49,000 crore to almost 4,93,000 crores in FY25. So 10x over 7 years. Now, on that base, they are hardly posting any growth. And of course, they're also impacted by lower NIMs. You're seeing credit growth soften. So banks will not be contributing a big time. In fact, it's a drag in the first half. We've seen in the first quarter, banks posted a decline in earnings. We're expecting a decline even in second quarter. And then hopefully from the second half, as the NIMs, moderate, settle down at a particular level and some pickup in credit growth after all the actions the government has taken, we should expect some expansion in banks' earnings, but it will still be it will still be below double digit. Second, IT, which is a very large sector. It used to have a 20% weight in index in December 2019. Today it is at 10.5%, so almost halved. And earnings are not doing anything great there either. They're growing at 4 to 5%. Third, consumer staples, which is another big sector. Again, we have seen the profits flatlining for last 2-3 years. In fact, if you look at the absolute profit number of Hindustan Lever, it has stayed at 10,000 crores now for 3 years. So 3 big sectors, banks, consumer, and IT, which together comprise roughly 50-55% of the index, they are not helping the index earnings growth. So what is driving this 8-10% earnings growth are smaller sectors. You have capital goods, you have cement, some bit of durables, retail, healthcare, a little bit of metals. So sectors which really are, which take up the lion's share of the index, they're not helping the earnings this year. They didn't help last year either. And that's why this market has become far more bottom up, far more stock specific, because the bigger sectors, they are flatlining for the time being. And there is a hope that FY27 we might see a good mid-teens kind of an earnings growth, while FY26 could be, hovering around 8 to 10%.
Gautam, appreciate that view. Hi, morning. This is Snehi also joining in. Gautam, we've been talking about the GST impact on consumption, but what about consumption ancillaries? And here I mean segments like food delivery, quick commerce. We've seen an upgrade coming in from your house just this morning. Give us a sense of what you're making of this entire space and how they stand to benefit or not. Either way, whatever your view is.
Yeah, so Snehi, good morning. See, look, in consumption, we've had a long-standing view that consumer staples will underperform. We've been having a big underweight in our model portfolio on consumer staples for last 4 years. Our entire weight in consumption has been residing in consumer discretionary. So much so that in July, we removed the sole consumer staple stock that we were holding. Today, if you look at our model portfolio, the consumer staple has a zero weight. Of course, they have seen a good rally in the last 30-45 days. But the discretionary segment is where we think far more excitement is visible. You have jewelry, you mentioned about food delivery, quick commerce. That is a segment which would see explosive growth in the time to come. We had Adit Palicha of Zepto presenting at our CEO track, and he did mention about expanding TAM and incrementally the industry's focus, as we've also mentioned in our note that we published today. The industry's focus is shifting towards containment of cost, consolidation of dark store addition, and that is consequently leading to reduction in customer acquisition cost as well, because platform charges have been hiked by both the market leaders. So we've actually raised the earnings estimate for both these companies, both top line as well as profitability, and we've also raised the multiples that we are ascribing to these companies. So both Swiggy and Zomato we continue to like. Swiggy we have upgraded the rating, but hotels is looking exceedingly well. Again, at the cost of repeating myself, we had Puneet Chhatwal at our CEO track. He's been a standout performer for the last 4-5 years. If you look at the performance of Indian hotels, we've been holding this stock in our model portfolio for 5 years. Today also, if you see the demand-supply gap, it's in favor of demand. So hotel upcycle could continue for a few more years in our view. And then you have plethora of consumer discretionary subsegments like innerwear, you have apparel, which has also got a boost from the GST reduction. You have footwear, which also is benefiting from the GST cut. So I think if you look beyond the next 3-6 months, which is where I think staples could bounce back because they've underperformed for a very long time. But if you take a 3 to 5 year view, then I think in consumption, a lot more money can be made in consumer discretionary rather than in the traditional legacy consumer staple stock. But do remember, last 10 years, consumer staple companies in India, not a single one, has been able to post a 10% top line compounding on a 10-year basis. So they've been underperforming significantly on earnings and top line, and which is what is now, after a lag of some time, reflected in their stock price behavior too.
Gautam, very quickly, outside the pool of consumption, do you have any other overweights?
Yes, Aisha, so we have a big overweight on capital market stocks. We like financials. We are overweight on financials, but large part of our overweight in financials is residing in non-lending NBFCs and some NBFCs. Aside of that, we have a big overweight on EMS companies, which is one of our favorite sector. And all the 8 companies which presented at our conference in EMS, they were talking about very substantial earnings. Well, in fact, we are talking about earnings compounding of 50-60% for some of these companies. So we continue to like Dixon, Amber, and even Keynes for that matter. Aside of that, we are overweight on industrials, we are overweight on telecom, and some bit of overweight is also there on auto now, which was a very, I would say, a stroke of luck. We upgraded just in time in July, and it is turning out to be the biggest beneficiary of GST rationalization. So auto, I mean, if you were to single out one sector from all these actions on GST, I would think auto is the biggest beneficiary. So those are some of the sectors where we continue to have a big overweight: financials, industrials, consumer discretionary, a bit of healthcare, EMS, and telecom.